Hello, everybody. Welcome to Friday, another Talk Money with Tom show. Really want to be able to answer your questions today. That's what we're here for. You can send them in to Ask Tom at talkmoneywithtom.com. And then, of course, we cover retirement planning, asset management, and tax planning. So send in questions. We've got questions that came in during the week. We cover things that came up with our clients during the week that we think are important. We're just trying to help everybody have a better retirement, at least financially. And so with that in mind, we've created this channel, Talk Money with Tom. We've got over 1,000 videos on here now. You can look at those, subscribe to the channel, hit the bell button. Increasing your education, we feel, is important to help you, with your retirement, even if you have an advisor, just get you farther down the road. And then, of course, we're available for an appointment if you'd like. You can come in and talk to us by phone, video, face-to-face. You go to our website. We have a book appointment button. Just push the button and find a time, half hour, that works for you and for us, and we'll try to answer your questions directly that way. So really looking forward to today's show and hope that we can find something that helps you with your retirement. All right, so we always like to start, of course, with a summary of what we saw happening here in the stock market this week. Now, I normally have a shorter term chart. This one I have weekly data, so every point on here is a week, going back to really the kind of the beginning of 2007, because I just want to talk about some of the longer term trends. We're really getting a lot of news right now about things that are happening now, right, with the House of Representatives, the situation in Israel, etc. So let's make sure that we have some perspective, on the overall trends and what's going on here. And so you can see here the S&P 500, we bottomed out March 9th, 2009. And then we had a very nice run up until 2018. We had technically a bear market there with a 20% drop, and then recovered from that. And of course, then we had that big drop from the pandemic, which was a 35% drop. Probably should have ended up in some form of massive recession / depression from that, but they pushed out money, tons of money. $10 trillion is the number I keep hearing, between the Treasury, the Federal Reserve, and Congress. And look at the effect to the stock market. It went basically straight up instead of going down, and recovered very quickly. But it created inflation. So the all-time high that we had there on the S&P 500 on the 4th of January of 2022 is really kind of artificial because of that money that came in. And of course that caused inflation, and we've had this rocky ride last year down to October 13th. And now we're on this trend, and I drove a little trend line in there. We're actually attacking that trend today. So we'll see what happens. One thing to keep in mind about today, always, the third Friday of every month is options expiration day. It seems to me that the market is down almost every time that happens, as these options are exercised and what have you. And it may not be relative to really the overall trends and what's happening. So be a little bit careful with what's going on that third Friday of every month. But nonetheless, we're still holding up that trend essentially. And we are above our support levels at 4,200 to 4,100, which is very critical. And so, we're still going up, and the uptrend is still in track. And if you look, we're kind of on track for where we might have been without that big bubble from the pandemic. And my theme has been for quite a while here that really we're just still unwinding the pandemic. I know it seems like it's sort of in the rearview mirror, but economically it really isn't. The inflation is still there that was really brought in by that money from the pandemic, and the shortfall of supply, labor and goods and what have you. And let's look at the bond market also, because there's a lot of news about the bond market right now, having this horrific time and a bad year and whatnot. But you need to put that in perspective. So this is going back to about the same time frame, early 2007. This is also weekly data. We're looking at the Vanguard Total Bond Market Index, ETF, as a measure of the overall bond market here in the U.S. And so I draw a line right there where it is now. Okay, so yes, it's down, but we also have to remember how much it went up.
That run-in from the pandemic.
Yeah, and so it's a bubble, just like the stock market bubble that we just looked at. maybe a little bit behind the stock market in that sense. But where we are right now, we're at for quite a few years there, and things are okay at that level. We had decent stock markets, and so really this is a lot. Again, we're unwinding the pandemic, getting back to a 5.25% to 5.5% rate from the Fed funds rate. Even a 6% rate is pretty normal. Those are things where the market has done quite well. But when you go from 0 to 5.5 in a very short period of time, that adjustment's hard, right? And so, we saw it in the banking system. So the banks had bonds, that they had purchased with the deposits that come in. All of a sudden, those bonds are worth less. They've got a shortfall in their capital requirement. They're going out to the market to try to find that, back earlier this year. And all of a sudden, those banks are starting to get, a run on the bank, so to speak. Government had to step in. And so, there are things that do happen when these scenarios happen with bonds, et cetera. Right now, the falling bond market's putting a lot of pressure on banking system, corporate bonds, those types of things. It's kind of leaking through to lots of areas. However, it's not that much higher than it normally is. It really isn't. And we're just getting back down to normal here. And it's a painful adjustment, okay, as far as that goes. But nonetheless, that's where we're at. If you look at the stock market again, that trend is still there. The upward trend is still okay. If we look at the bond market, we've still got a situation where we're kind of getting back to normal.
Yeah, we really got used to having a below average interest rates, and people just got used to that as the norm.
Right.
And for our history, we've been around higher than that.
Yeah, exactly right. And we've functioned at those levels without any real problem. 95 to 2000 was one of the best 5 years in the history of the stock market. And my recollection, and I could be wrong here, was that the Fed funds rate was right around 6%, roughly around where it is now. And so, there's plenty of room for the market to move here. We're just readjusting back to kind of this, I guess it's almost like a sugar high that we had from all of this money that came in to save us from the pandemic. You can make arguments whether we should have done that or not done that, or we did too much or what have you, but if we didn't do anything, I think we'd still be talking about the Great Depression that we're in right now.
Yeah, hindsight's 2020.
Yeah.
You never know how much you need from this when you're in the heat of the moment.
I remember Jim Harbaugh, the 49ers coach at the time, and they'd gone for the touchdown in the Super Bowl, against, I think it was Baltimore, 3 times in a row, threw the ball to Crabtree every time. And they asked him if he would have done something different, and his comment was, coulda, woulda, shoulda is undefeated. I still like that because it's very true, especially when you're looking at, the stock market as far as that goes. So very interesting. Okay, then the other thing, of course, with this Israel conflict that's happening here, it has the potential for creating a higher oil price. And higher oil price is a real problem, especially right now, because of the situation with inflation already being fairly high. And oil comes through everything we buy, every service. The restaurant uses energy, the goods that get you from Amazon is using energy. You go to Target, that stuff got delivered there somehow. So as that pricing comes up, it can really create some problems with earnings and or those price increases being passed along to the consumer as a problem for inflation. So what you have here is a long-term, again, about the same, early 2007 chart of West Texas Intermediate crude oil pricing, right now about $88. I drew a line all the way across there, kind of where it is now. We've been around this pricing quite a bit. I don't see this pricing where it's at right now as being an issue. And so far during this conflict, it has more or less stayed in this range. It's been kind of in that 88 to 93 range, as far as that goes per barrel. And however, that is the threat there. A contagion, Iran getting involved, whatever it might be that could interrupt the supply of oil in some form or fashion, right? That could create problems. So, however, again, at the moment, we're just kind of back to a sort of a normal area for oil. And you can see how low it got just over my shoulder here during the pandemic. And that's because nobody was using it.
Yeah, there's times when it went negative too.
Yeah, that's right. It cost more to store it than it was worth at that time. So kind of wild. All right, so here's another thing. Wage growth. So here's another risk factor. So inflation, I think, is the biggest risk. Okay, recession is off in the distance at this point. And I've been saying that for quite a while. I still feel that that's true. Oil is an issue for inflation, right? And so is the wage growth and how much people are getting paid. And so right now, the wage growth is at 5.2% as of last month, year over year. Not quite enough to keep up with inflation, and so we're seeing some, strikes that are happening and what have you. And so we'll have to see what happens with wage growth as kind of employees push back on that. But the overall trend for wage growth is slowly but surely coming down, not up. And so again, that's something we watch for, but the trend's going in the right direction. So we got the market overall going in the right direction, the bond market getting back to normal, oil is kind of at an average price. We've got wage growth that's, somewhat reasonable in terms of its trending motion as far as that goes. The average wage growth is 3.74%. Okay, so 5.2 is higher, yep, reflecting the higher inflation and the tighter job market, right? But not out of control. That's a healthy number. That's not a bad thing where we're at right now. And then kind of the last, second to last thing is just inflation itself. So please keep in mind that core PCE, remember that, core PCE, that's what the Federal Reserve is looking at. PCE is the price, personal consumption expenditure index, and that is essentially the basket of goods that the Federal Reserve looks at for inflation. And they look at the core portion, which excludes food and energy, which they feel they control more of the core aspects of it. That's at 3.88% right now.
Yep.
And so really need to get that to 2. Still got a ways to go.
Yeah, we'll find out a week from today.
Yeah, because it always comes out at the very end of the month for the month prior. But the trend is not bad. It's coming down a lot slower than it probably needs to, but it is still coming down.
Yeah,
right.
Inflation tends to be sticky.
Yeah, it does, and but it's, again, you look at all of the things that are happening right here with wage growth, with inflation overall, with the price of oil, with the bonds coming back to normal, the trend on the stock market. Again, I'm doing this because there's a lot of fear right now.
Mm-hmm.
Because oh boy, we're coming back down again, what have you. And here's the fear gauge. This is kind of my last point. So this is from Bank of America. It's a bull and bear indicator. It's a gauge of, essentially professional money managers.
Yep.
And when fear is very high, that has shown to be a time to buy.
Yeah.
Right? So when this gets below 2, it just hit 1.9, it's a time to buy on a contrarian fear gauge like this.
Yeah, it's happened 20 times since 2002, and the median return for the U.S. stock market is 5.4, and global equities is 7.6. So
and that's like over the next quarter.
Yeah, over the next 3 months.
Over the next 3 months. So 5.4 and 7.6.
Yeah.
On global. Okay, so again, we're reaching a sort of an extreme in terms of the fear. Obviously, there's things that we're worried about. We're worried about what's going to happen in the House, and can they get a speaker in place so that they can start to function. We're worried about the potential contagion in Israel, legitimate concerns. But when you look at the stock market, those types of worries tend to bring the market down too fast, essentially is what happened. The stretch, it comes down so fast, and you pull and pull and pull, and eventually it snaps back up. One of my favorite indicators for looking at stretch is the Wilder's Relative Strength Index, RSI, on a 14-day basis. When that gets below 30, we've seen the market jump quite often. It's at 36 now. It's not quite there, but we're kind of lining up, in my opinion, over the next week or two here to kind of maybe stretch down to that level, get to that base of support at 4,200 to 4,100, and then have some type of a snap-off return. That's been my premise really since July, that we could get to that level, get that snap return upward, and then maybe get some short covering to come in and get a little rally going, and then people start to jump in on that rally. We'll see how this plays out. Obviously, it does depend on these other things and how they're going to play out. But don't discount, and that's been the emphasis behind this show and my daily videos since I started this. This video series started on the 23rd of March 2020, right? Sorry, the 22nd, it was a Sunday. The 23rd was the low for the pandemic. And I didn't predict the low or anything, but I started it because the panic was so high. I just wanted to point out some of the things that were good. the money that was coming from the government, the Federal Reserve lowering rates down to zero, the bond market was skyrocketing, pointing out so that people could have some kind of balance amongst their, thought process, because we do get so much news that is negative because that's what people click on, and it's what people like. And if you're trying to drive a business and a marketing aspect, we probably get a lot more views if I talked about all the dire things that could happen, right? It doesn't really fit my personality, so it doesn't work for me. But I also feel like it's the wrong way to look at things if you want to be a good investor. It's about finding a balance between that bad news and sort of the good news. And we want to provide, not Pollyanna thing. We're going to point out some of the things. Last year when the markets come down, we were talking about why and how that works and whatnot. But right now, when you look at, there's an awful lot that I can point to that isn't bad at this point in time. There just is. That's a fact. And so, and not many people are really pointing those out. So hopefully that helps you with this too. So appreciate everybody joining, us for the summary of the market. I really think this is an important thing. Oh, let's cover one more thing, the signals. So unfortunately right now we do have double red for the stock market and double red for the bond market. However, and so there's a time to be cautious, no doubt, and just, hunker down, wait a little while. It's not a time to panic because there's too many other pieces that are, really positive as far as that goes. But, we do pay attention to these also. So anyway, thank you very much for joining us this week. Look forward to being able to talk to you again. However, we will not be here next week. We'll be here in 2 weeks.
No,
we'll be here next week, but not the week after. Okay, Sorry. Good. Got it. Okay, good. Let's go with our first question.
How does the Israel-Hamas war affect the world market?
Yeah, there you go. Yeah, not surprised with that question because that's the one I've been getting from my clients all week as far as that goes. This is a very dramatic event. It's, got potential to be, it's a hot spot in the world.
Yeah, it's
right?
It's a powder keg, and will this be the ignition for it?
It is, right? And, all the big players behind the scenes and see how that plays out. So it's kind of fascinating to see, obviously, how this plays out. However, it really isn't in a lot of ways, right? I mean, we would rather, we've had a lot of things kind of get in the way of kind of going in the right direction. We had the Ukraine situation, we've had this situation with the debt ceiling resolved itself, we have the situation of speaker, and now we have Israel, and it's no wonder the market isn't skyrocketing in that, environment of potential risks. People don't want to add more risk. Now, professional money managers are much better at handling that risk, and they're the ones really driving the market, and they will come in when they see good prices. However, when we look at Israel and we look at what's happening there, we have to ask ourselves what could impact earnings, okay? So there's some very specific things that can happen, like, for example, the airlines have been coming out and saying that they expect an impact to their bottom line because of travel into the area. And so that's not uncommon. You get these little pockets of impact. I would be much more concerned about overall impact because we generally invest in the overall market. And so that's what I'm really concerned with. So oil is the most obvious thing, and the price of oil. And so Iran is a big producer, and they have been trying to advocate to cut Israel off and get other countries to join in from basically an embargo on oil. And there could be embargoes going the other way if Iran gets involved. Maybe we embargo their oil, etc. And oil goes from it's $88-90 a barrel that it's at now to that much higher level, and that creates inflation, potentially even creates recession. And so that's why you really want to watch the price of oil in this conflict. And really just, hope that there isn't a continuation of spread and what have you as far as that goes. So, we'll have to watch how that plays out. But I always look at it, and again, as an investor, I look at it from the standpoint of, how does this situation impact earnings? And that's what the market looks at.
Yeah, and you can kind of use the Russia-Ukraine conflict as a recent example that you can use as a kind of a study or use case.
Yeah, it's a good example in the sense that the market dropped right away because of the fear. That's kind of what's happening right now. And then the market kind of settled in. And the conflict is still just as bad as it was, but we're not talking about it. The market has had a good run this year, even with this downturn. And so there is that aspect of every time something happens, so leading up to every one of these conflicts or, right as they first start, if it's a surprise start, then, we end up with a downturn. So there's an impact there. But really the longer term impact has to do with, well, now oil went to $130 a barrel during the first part of the Ukraine invasion. And so that's a pretty high number. It's gotten to 170 before, but nonetheless, we survived that. The markets did okay in that environment. So we've got a little bit of room here to play with. We'll see how this works out, but it's a good question.
So this question came in from Bruce. We're fixing up our house and preparing it for sale. Can you offer a tentative timeline on when interest rates will become more favorable for buyers?
Oh, yeah. Well, here's the scenario I would look at. A couple weeks ago, we presented the Fed's dot plot.
Yeah.
Right. So the dot plot for the Federal Reserve, they put out 4 times a year. Every dot represents one of the Fed governors, and they basically project where they think interest rates will be, 2023, 24, 25, 26. And they actually show rates going up just slightly as a whole at the last meeting anyway for 2023. So maybe one more rate increase, although that seems to be backing off as we speak now. That was back in September.
The CME Fed watch is at, it was yesterday was 99%, and I think today is 96% for a hold.
For November, yeah. And it was sort of a toss-up in December, but now that's getting to be more of a less toss-up because of some of the issues that are happening, mainly because bond prices have come up so much. Bond yields have come up so much. They're looking at that as already sort of like a rate increase. So to get to your question there, 2024, if you look at that dot plot, they are projecting that interest rates would be coming down. Now, when they are interviewed and they talk, it's kind of fascinating. They're talking about possibility of not lowering rates next year and those types of things. However, I would say the projection is probably pretty strong that, rates could start to come back in the second half of next year. So if you're fixing up the house right now, and you're looking at interest rates as being one of the main drivers, then second half of next year might be lower. However, the interest rates are really market driven. And so they're coming up right now. They're nearly at 8%, mainly because the bond market is selling off. I think the bond market sell-off kind of fits in that too. I'll bet you we start to see some real stability in the bond market in 6 to 9 months, which kind of fits in with, what's happening on that dot plot. I guess the thing you have to be aware of, it could be that they're lowering rates because there's a recession happening. So if it's a light recession, probably doesn't impact real estate that greatly, but a heavier recession could. And so really what I'd be looking at might not be the whole thing about interest rates, because people are still buying homes.
Yeah.
I mean, in our area here, I go for my walk with my wife, and houses come up for sale and boom, they disappear pretty quickly, and it really has to do with supply and demand. And because one thing I will say, if I was a buyer, I wouldn't be happy to have an 8% mortgage versus what I might have been able to get a 3% mortgage not that long ago. However, I also might be saying to myself, look, that could be temporary because I can refinance.
Yeah, and they could. You never know where interest rates go. So if some people will say, hey, it could go up, might as well lock into 8, and I can always refinance later. And Bruce had the information that the house will be ready early 2024.
Early 2024, yeah. I'd probably be, not so worried about the interest rates. I'm not sure that's the main driver here. Houses are still selling even though interest rates have gone up. What happened is that the demand, even though it's dropped, is still higher than the supply.
Yeah.
Or high enough. And somebody used an analogy once, a realtor client of mine, that, maybe I used to have 100 people that wanted to buy my house, and now I just have 10, but I'm still going to sell it.
Yeah.
Because one of those 10 is going to qualify and step up with the right amount of money and such too. So, the economy is still good. Job market's still good. Wage growth is okay. And so I would look at more of those metrics than what's happening. It'd be great if the mortgage rates came down. That would stimulate things.
Yeah.
But I think Easton right too. Maybe somebody's worried about it going to 9, and they want to buy it before it gets there, right? And so there is some kind of push to get off the fence and get that locked in at that point. So I think probably the real estate market has exceeded expectations.
Yeah,
in
even
this
though
downturn.
prices aren't going up,
Right.
they're maintaining steady because there's
Yeah.
so little supply on the market. Because a lot of people don't want to sell because they have interest rates that they've locked in from the pandemic lows, and they just want to hold on. So any properties coming up for sale, there's some demand for it.
Yeah, that's exactly right. I mean, so it's always supply and demand, right? Interest rates are part of that demand equation, but if the supply is really low, there's still people interested in trying to buy these homes, and so yeah, there's some there's some good hope for early 2024, in my opinion, still rolling along. The job market is showing very small softness just recently, but it's actually doing much better than anybody would have predicted, a year ago. I think that kind of continues through the first half of 2024. So I think that's probably a better metric than anything.
So what are tax credits and how do they work?
What are tax credits? So generally, a tax credit is it's like the government paying your taxes in a way,
Yeah.
right? So I mean, if I have a $10,000 credit, and you can get credits from different things, from EV purchases, electric vehicle purchases, solar purchases. There's different things.
Sending your kids to college.
Yeah, exactly. And so if I have a $10,000 credit and I owe $10,000 worth of tax, I don't have to pay any tax because
Yep.
my credit is offsetting the taxes owed. And so there are different types of credits.
Yeah, so you have refundable and non-refundable. And so with non-refundable, you can only use the tax credit up to your liability. So if I have a tax credit of $10,000, but I only have $7,000 of tax liability, I can only use $7,000 of that tax credit. Refundable means that you would get the excess refunded to you. So the IRS would send you a check for $3,000.
And sometimes those non-refundable ones can be carried forward and rolled into another year, and you could use that $3,000 credit that's still left. So it depends on really how the credit is structured. They're all a little bit different, actually, but it's an interesting question. It's a good concept to think about and look at. There's a lot more credits out there, especially in the energy, electrical, car area than there used to be.
There's been a lot of push for green, and so tax credits usually are incentives to get people to do something.
Yep.
Whatever the government wants you to do,
Yep.
they'll incentivize it some way.
What, the heat pump thing, all these things that are out there, efficiency in your house and what have you. They're trying to help, use dollars to try to get people to move in a certain direction.
So our next question is, how does the House Speaker vacancy affect the broader market?
How does the House Speaker vacancy affect the broader market? Okay, so it doesn't help in the sense that, there's this uncertainty about what is going to happen. The market is a risk-taking adventure, right? And so if I'm going to take a risk and I see lots of other risks around me, I might take less risk, right? So that's, however, and actually we had a chart from that. Let me see if I can find it. Yeah, it's not a great chart because it's hard to see. But these are all of the budget shutdowns that we're facing November 17th, right? That they extended to the 17th. And there's been a lot of them. This is since 1976. The week before the shutdown has led to an average downturn, but only 0.4%. I mean, today we're down 0.6. Or we were before. Yeah. So it's not. That's like nothing. That's like a daily motion. Now, again, last time we looked at this, if I pointed out that the times earlier were more dramatic than times current. So the actual days that the government is shut down, the market actually went up overall, 0.1%.
So basically flat.
Yeah, basically flat. So, which isn't great either. I'd rather have it be going up and not have a shutdown. It's obviously a very dramatic impact on the government, the functionality, the people that aren't getting paid, the FAA. There's this whole thing with, I read an article about how they were requiring in the last shutdown, which was the longest shutdown, 35 days, where they were requiring the FAA
To work.
air traffic controllers to work without pay. I'm assuming they got their back pay once things reopened, but um, nonetheless, so it doesn't have a lot of impact
I think
on the markets historically.
I think the bigger risk is how does it affect the U.S.'s credit worthiness.
Yeah.
So I think was it S&P or Moody's?
Who's the last one? I think Moody's is the last one that hasn't moved us off of the top one. Fitch moved us and S&P moved us off their top rating, and Moody's still has us on their top rating. I believe that's correct.
And Moody essentially threatened or said if there is a government shutdown, they're going to downgrade the U.S. And so that's the risk: is how much extra borrowing cost would we have in the long term?
Yeah, exactly. Yeah, because those are every time you get downgraded, your bonds, generally speaking, have to come out at a slightly higher rate to attract attention. It's not quite as true with the U.S. as some other places, but nonetheless, if we had a higher rating, we'd probably be able to do less interest on our treasuries and pay less. So, yeah, that's a factor as far as that goes. But it's not a huge impact on the stock market. I do think the combination of things that are happening here is probably bothering the market, and we've had a down week. I think a lot of this is just the accumulation of risks, or it just doesn't look good.
Yeah. So what is deferred compensation, and what are the pros and cons of it?
Okay, so deferred compensation is where you are at a place of employment that offers a deferred comp program where you can take some of the money that you were going to earn and not take it, and it goes into this deferred compensation pool,
and so like a 401k is considered deferred compensation, but like for this question, it's usually talking about non-qualified compensation. So it's not your IRAs, your 401ks, your HSAs. Those are kind of considered retirement plans and have a lot of rules regarding them.
Usually we see these with highly compensated executive level, here in the Valley anyway, employees. They can be selective, like a 401k and some of these things that have to be very equal across the
because they are qualified plans, and so the government gives them special treatment. They have to follow basically rules and regulations. So essentially, rank and file employees have to be offered this, but non-qualified deferred compensation is kind of outside those rules, so you gotta pick and choose who qualifies to be part of it.
Yeah, so if you're making 800,000 and you don't need 300 of it, you could say, okay, I'm going to let that go into the deferred compensation. I don't have to pay taxes on it. Some of them grow too; they can be invested, and any of that growth is deferred and tax-wise until I take it out. When I leave the company, then they start to pay out this deferred compensation. So maybe early in my retirement or what have you, or if I take a different job, it can pay out monthly, quarterly, over a 5-year, 10-year. They can decide what they want, and actually they can do it by year. They can make up different payout periods.
Yeah, so it's highly plan dependent. They could have it so when you leave the company at your retirement, or they could have a specific age.
Right.
Then they have different frequencies of payments, what you can invest in. So it's a very unique to each company, the plan.
Yeah, because it's not qualified, there aren't a lot of regulations and rules, so they can kind of make up their own program, essentially.
And so the pros is you get to lower your tax bill, in a sense that the idea is you defer your compensation, so I can take money from this high earning period and try and move it to a lower period of time, and so that way I save on taxes.
Yeah, so the con, of course, is that you're now going to have some potential uncontrollable income coming in.
Yeah.
And we actually have seen some cases where they weren't getting it at lower tax rates because they had so much in deferred compensation set up that they're now getting hit with this big inflow of money that they can't stop. Or, it's a good problem to have, but it does, unfortunately, set up a situation where you could have paid taxes on it at this point in your career, and now you're getting this massive amount of deferred compensation to come out, and you're actually getting taxed maybe even higher than you would have. However, you did get, and this is one of the other pros, you did get tax deferred growth.
Yeah, there's no tax drag on that
also, which you would not have had if you had taken that 300, paid the tax, invested it. You would have been paying taxes on all those dividends and capital gains all the way through all those years. So there is some offsetting, compensations in there. I guess the biggest con, the thing that people worry about the most, is it is a general obligation of the company. So what that means is that essentially it's their money until they pay it to you. And if they go out of business, there's a possibility that you won't get your money.
Yeah, it's like you make an unsecured loan to this business, and so if push comes to shove, they can use that money to pay their other obligations.
Yeah, there are other secured situations. So obviously you want to look at the company, right?
Yeah.
And when you're doing these, and make sure that they're sound and can, hopefully survive long enough to get you your money as far as that goes. So
yeah, so a lot of people try and evaluate, do I think this company will be around for the next 10, 15 years to pay out? And that's a big calculation too.
Yeah.
And so that's why you don't want to overfund deferred compensation, because you're putting that at risk.
Yeah, it's a good question.
So what are you looking for when you are looking for kind of bottom fishing investments? So something towards the bottom of their low price range. Airline stocks right now look quite cheap because of a lot of what's going on with the Middle East.
Yeah, as an investor, I'm what we would consider a momentum investor. I like to buy things that are starting to roll. I call it catching waves. And so we have 181 ETFs on our list that we're interested in, and when those start to move up and they start to go, we want to catch that wave. And the idea of kind of inertia just keeps going. And so if you look at inertia on the downside, that's not a good thing.
Yeah.
Because it could keep going, right? So, they have a saying, don't try to catch a falling knife, right, on Wall Street. And that's essentially what you'd be looking at, but with some of these situations. However, I could make an argument for airlines in this scenario, because I'm not a huge airline fan. I don't buy airlines, generally speaking, because I think their business model is really rough. They've got the oil to deal with, which is out of control, safety issues, which are huge, massive mechanical, costs and labor costs, and highly trained pilots that cost a lot of money, etc., and competition, which is really fun. So, that aspect of it is always kind of. There are other businesses that I like better, that I think have better models as a whole, software companies, for example. But right now, if you look at airlines, they're down quite a bit. One of the ETFs out there is ticker symbols JETS, JETS, and that's down quite a bit.
It's getting close to the pandemic low too.
It is, and it's stretched down. The RSI, which I talk about, which is the Relative Strength Index by Wilder, at 14-day RSI is down like at 23 right now. And generally speaking, below 30 is a really good buy point. However, it did get down to 16 not too long ago, came back, and now it's back down again. So, that's the falling knife. You've got to be patient with that type of thing. But I think, one of my clients on his own bought jets actually in 2020, because it really came down, as you mentioned, because they weren't flying anybody. And did quite well, actually. Made a nice run and made a nice profit on that. So it's a different type of investing. It's a contrarian investing than I use, but you could make an argument that the situation in the Middle East will eventually resolve itself, and airlines will get back to where they are, and you have the pandemic pent-up demand for travel still coming, right? Still coming. And the travel this summer was pretty good. And I don't see that abating anytime soon. So if they're down because the Mideast, the pent-up demand's still there, you could see an opportunity to buy. Mideast situation goes away, the pent-up demand still comes through, and all of a sudden these airlines are reporting decent profits. Right now they're just warning about the possibility of lower profits because of what's happening in the Mideast, which is the right thing to do from a corporate, compliance standpoint.
Yeah, and you're looking at, if you're holding for a while, this is not a bad entry point.
Yes. Yeah, exactly right. So if you have patience, and I always, if I'm going to do this type of investing, I'm dollar cost averaging. If I have whatever I have that I might want to invest, 10,000 or 100,000 or 1,000, whatever the dollar amount is, I might go in 25% here and see it go down a little bit more, another 25%. And so I might, kind of go for it. And if it starts to pop up a little bit, I might put another 25% in, so that to get to my full allocation, maybe put it in a little bit at a time, and try to see where things go. So I always use GE as an example. So this is one of the greatest companies in history, was one of the original Dow components from 1880s. And they hit a hard spot here where for 3 years they dropped, and they came down 90-ish% from their high. And now they're doing well, right? So if you would have caught that falling knife, but a lot of people are buying GE after the first year and the second year. So you have to have a lot of patience, and maybe you don't allocate all of your money towards that. You just continue to kind of dollar cost average in. It's very difficult to tell where that bottom is. Obviously, if you'd have done that, you might still have some shares that are, underwater, that you purchased after the first year. But that's what I look at with any of these things. It's just that you don't know where that bottom is. So you kind of want to dollar cost average into that a little bit slower.
And so if you're doing this, you have to have some sort of conviction that you're going to see a return. But you also don't want to get fully attached to it. So at a certain point, you say, hey, it's still going down. Maybe it's time to cut losses.
Yeah, I've been accumulating Target, over the last few years. They've been having a hard time. Stock has been down. They've had several different issues, but I have some conviction in Target long term. I don't need the money right now, and so that's an example of something that I've been doing, kind of that falling knife concept. But I've been doing it slowly and continuously, dollar cost averaging. When I see a big stretch to the downside and RSI gets near 30, that's when I want to accumulate a little bit more. And I'm hopeful that at some point they get everything working again, and it goes, because you go to a Target, they're pretty darn busy. And so I don't see them disappearing as a brand anytime soon. But anyway, that's an example of kind of some of the things that happen. But okay, I think maybe we have time for one more quick question. Anything?
Can I use tax credits for Roth conversion?
Ooh. So yeah, earlier in the show, somebody asked about tax credits and what are they and how they work. And so, let's say that you buy a solar system and you get a tax credit for $10,000, right? You could use that tax credit to offset the taxable income of moving money out of your IRA and converting it into a Roth IRA, right? So the answer is yes. And you can pretty easily do the calculation. And let's just say that, that money is going to be in the 24% federal tax bracket.
Yeah.
If you divide, 10,000 by 0.24, right, you're going to get pretty close to 4 times the money, which is the 40,000, a little short of 40,000. So you can convert from your IRA roughly $40,000 worth of your IRA into a Roth IRA. You'll end up with roughly 10,000 worth of tax. You got that 10,000 credit, and so the credit pays the tax for the conversion. And now you have $40,000 that's now growing tax-free for the rest of your life. There's no required minimum distribution on that, so you can keep it in there literally for the rest of your life. You're not forced to take it out. You can put it into stock markets and the bond market long-term, make some really good money without having to pay taxes on that growth. So kind of, it's a way to use that tax credit to maybe benefit yourself. It's maybe not enough money to be jumping up and down about if you got a lot of money in an IRA or whatever, but it is a way to use that tax credit that is kind of intriguing as far as that goes.
And whenever you're doing Roth conversions, you should always be aware of where you fall into your tax bracket, because you don't want to convert too much that you jump into another tax bracket. And so those sweet spots are kind of like that 24%. So you want to avoid jumping into that 32% bracket.
Yeah, and correct me if I'm wrong, but when you do a conversion from an IRA to a Roth IRA, there is a 5-year period of growth that's needed in order for you to get that tax-free growth.
Yeah, essentially, you would have to wait 5 years. If you pulled the money out early, you would be considered taxable income.
Yeah, so that 40,000-ish that we just converted would need to sit there for 5 years for you to really get the benefit, which again, if you've got the money, that could work out quite well. So anyway, that's what's worth considering there too. All right, well, that's our show. I want to thank everybody so much for coming. Really enjoyed it. Thanks for the questions. keep sending them in. We'll be here next week, so send them in during the week. Give us a chance to kind of take a look at them. You send them to the email address, asktom@talkmoneywithtom.com, and we'll be happy to, try to answer them at the next show. Obviously, subscribe to the channel. It helps us, actually. It helps you. Education, we feel, is very important to hear. You can hit the bell button. You can put in comments. You can do likes. You can do all kinds of things there if you'd like. That would be great. And then lastly is just the ability to talk to us directly. If you have a question, whether you're a client or not a client, we're happy to spend 30 minutes, kind of answering whatever questions come up. You go to book appointment button and get to our schedule and find a time to meet with Ethan and I, or one of us for that matter. But so look forward to being able to see you next week. Thank you very much for coming today.